The Vunani Domestic Target Return CPI+5 fund has a mandate to deliver returns in excess of 5% above inflation over a rolling 3-year period. The fund had a great year in 2012, delivering a return of 18%, which was obviously far in excess of its mandate. The fund achieved this by being overweight in equities and investing in companies that were able to deliver earnings growth. Manager Tony Bell joins us in studio to tell us whether the performance will continue from last year. Tony, is that? I think that's the first question to start off with. Are we going to see 18% again?
Warren, we're in an interesting phase because I think in some respects the easy money's been made. Your previous guest referred to equities climbing a wall of worry. And I think for a lot of investors, they're now pretty much at a crossroads. There are some that have been long equities and have banked the returns. And there are those that have been short their allocations and fallen short of performance targets. In the group that I look at, the performance ranges from 7 to 18%, which is quite a wide margin. I think if you have got some performance on the scoreboard, it's easier to move forward. If you haven't, it's a lot more difficult because you're trading regret at this moment.
You heard the discussion we had with Philip before the break, and we're talking about equity risk premium and this balancing act between expectations and what we can expect going forward. Just with reference to the domestic market, what's your sort of take on what sort of equity risk premiums you look at as a multi-asset manager or a balanced manager?
Yeah. Warren, we try to keep it quite simple. I think the challenge with a debate like this is you can get awfully lost in the sea of statistics. The work we do back at the shop really divides the world into 3 states: bad state, normal state, or very good state. Where we see ourselves at the moment is in the normal state, where we could expect returns of around 6 to 8% real from equities. If we do move into a very good state, those returns do go higher, north of 10. And the crucial point in managing this sort of fund is if we go into a bad state, then those returns drop to about -5 to -6% real, which is where one wants to really protect the investor from drawdown risk or the risk of capital loss. So at this point in time, we see real returns of 6% going forward in 2013 very achievable.
And that's including dividends, or is that excluding dividends?
That's excluding dividends. I think what is changing in the debate is the source of the returns. Previously, we've had very good returns from consumer services. We're particularly underweight consumer services. For the viewer out there, that's retail stocks. The reason being we think that they have pretty much run their course. The stocks still look expensive to us, and the companies are struggling to maintain double-digit earnings growth. Companies that have diversified earnings bases offshore, like Richemont and breweries, we're more encouraged by that, simply because the rand weakness helps, but those companies are in markets where you have diversification geographically, but you also have diversification of earnings from a product source. And I think stock picking and sector rotation is going to be crucial in maintaining those levels of returns going forward.
You kind of indicated in your brief to me that the performance was, and we mentioned it in the introduction, was that you were overweight equities. What's the maximum limit that the fund can enjoy in equities, both locally and offshore?
The new CISA limit, 60% for equities. At the moment, I've positioned the fund in the lower 40s for domestic, and we're sitting up with a full 20% offshore allocation in equities. Within the local equity market, we've biased the fund heavily towards rand hedge stocks, and we've favored consumer stocks that are able to benefit from growth in foreign economies, principally the East, Asia, and America. And so stocks like Richemont, Naspers feature quite prominently in the portfolio. So we'd say at this stage about 60%, 65% of the fund's earnings power is linked to a declining rand.
A declining rand. Now, is that not a concentration of risk for a portfolio manager? Because we've had the situation, obviously 2001 was a great example where the rand went to 13 and then came all the way back to 6.
Sure.
And there is always the chance that things can change quite dramatically on the macro scene.
Sure.
How do you hedge that?
Okay.
How do you hedge that?
A couple of ways. Firstly, our primary decision is driven by what Benjamin Graham referred to as earnings power. That's the most important part. We look to see where each company generates its earnings from, and then we look at the rand hedge qualities. So even a company like Old Mutual, which has turned out to be an increasing rand hedge stock, is a more exciting story from the point of view of it deriving more of its earnings source from emerging markets. Companies like MTN, where you've got very specific currency risk, those need to be factored into assessing how much margin of safety exists in each of the in MTN's current share price. And so where currency becomes a specific risk relating to the ability of the company to deliver earnings, we pay very close attention to it.
So besides so obviously a nice diversified base that's exposed to the emerging markets, you indicated that you'd been able to pick some of these companies that were delivering earnings growth.
Right.
Has the thesis changed? You've mentioned these great large cap companies listed domestically. What are some of the things? Is that going to change? Are you holding these positions, or has there been a rotation into some other different stocks to give you that?
We're finding value a little harder to come by in this market. We've done quite a big rotation recently out of the retail stocks. In early January, we rotated out of retail into rand hedge stocks. We're starting to pick up stocks exposed to basic minerals in the mining sector. And we also think that the unsecured banks, particularly Able, have been hit very hard. So our buffer in the financial sector is to really be long of companies like Old Mutual and some of the core banks. And then where we see value in stocks like Able, we're accumulating at this point in time. And then the buffer from a rand hedge perspective, stocks like Richemont, BAT that I've mentioned, together with things like Naspers, that balances the portfolio out quite nicely. So it's very much a balancing act between the different drivers that input into the overall fund management decision.
You've mentioned obviously quite a big exposure to offshore equity. Mm-hmm. What's been? Are you pursuing the same type of model there? You're looking for big companies with earnings streams that are coming from emerging markets and growth markets.
Yeah. One thing we're watching very carefully now, just to build on that, is we're a little concerned. Two triggers, if you like, that we're watching: the dollar and U.S. long-term treasuries. Your previous guest mentioned the impact of offshore earnings on US-based companies. That's very true. At the moment, about 35% of earning streams flowing into the US come from non-US sources. So where currency becomes terribly important is where you have the potential for a strong dollar. That could undermine the sort of earnings base that investors are currently counting on in terms of the valuation of the S&P 500 at the overall level. And any dollar strength will, of course, weaken that earnings base and hence be a potential catalyst for investors to pull back on their overall risk bets. The US Treasury, we're looking at very much from the point of view of trying to gauge inflationary pressures. The sort of truism in the market at the moment is because the Fed, the ECB, and the Bank of Japan are rapidly expanding their monetary base, inflation is inevitable. We really don't see that as an immediate threat because final demand is still very weak. So it's a minefield that has to be walked through very, very cautiously at the moment, blending both the asset allocation call and also the stock selection. To mitigate some of the risk, what we've done is we've used the very low levels of volatility that have been in the market for quite a while. People would be familiar with the VIX offshore. In South Africa, we refer to the Savvy, and we've just bought some out-of-the-money put options for clients at very, very low rates.